Vince, I'm pleased to say, is the MP for Twickenham, which is where I live, so I'm a voter, and where Brand Finance was founded and still is based. So I think in many ways it's an interesting metaphor for the banking world. Vince has been an absolutely fantastic local MP for the Twickenham area. And in some ways you would think, isn't it amazing that someone of his political persuasion is actually the MP in that area, because it's quite a Tory boy place. And the reason is that he delivers an extremely good MP service to the area. And many, many people would say that. So there's my personal reference for him. As a state-level politician, he is an economist who studied at Cambridge, Glasgow, and is a fellow at Nuffield. He's on the governance panel at the LSE, and interestingly, for a politician, spent many years as chief economist of Shell. As you heard, he's had various senior positions in the Liberal Democrat Party, and is now Secretary of State for Business Innovation and Skills. Interestingly, he is quite often positioned as a bogeyman of business and of banks. So I expect, well, certainly I am looking forward to hearing what he's got to say on this occasion about competition in the banking world. So over to Vince for his presentation. And it'll be about 10-minute speech and then 10 minutes of questions. So get them ready. Thank you.
Well, thanks, David, for inviting me, and thanks for your testimonial. Hopefully get me re-elected next year. I'd like to think of myself not as a bogeyman of business. I like to think of myself as very pro-business, but I have had a slightly more ambiguous relationship with the banks, or some of them. I do take that. I know you've had sessions already on the broad competition issue, but I will go over some of that ground. Essentially, what I want to say in 10, 15 minutes is say a little bit about how I see the problem. You know, what is it? What do we mean when we talk about bank competition? Something about the trends, which are in some ways quite encouraging, at least at the margin. Something about government or policy intervention in stimulating competition, the role of the business bank. And then something about the issues that are coming over the horizon, and I think you've been dealing with one of them, which is technology, another which is referrals and how we deal with that. But let me just start with the problem. I think there are some issues which are long-standing, some have come to the fore during the financial crisis and after. I mean, in terms of the long-standing problems, we've had a concentration of ownership in banking for very, very many years. Some of you will remember the Cruikshank report back in the year 2000, identified in the SME lending area very high concentration, and in his language, not mine, excessive profits on the back of that. For whatever reason, very little was done about it. The bank industry organised quite an effective pushback on that, and many of the things that we're now doing at haste could probably have been done 15 years ago if Cruikshank had been acted on. Probably just to stress when we're talking about concentration of ownership, I think that there's a danger of sort of lumping all banking together. I mean, clearly in the mortgage market, there's much more competition than there is in SME lending. You've got building societies and you've got new people coming in like Virgin. It's a very different story. But certainly in SME lending, where I think the big four account for roughly 80% of SME business, the big five, if you include Santander, something like 88%, something of that order. So what I'm primarily focusing on is the competition in business lending. And again, I'm talking the small, medium end. At the top end, of course, big companies have access to capital markets, international capital markets. There's plenty of competition around there. So it is a rather specialized issue that we're dealing with here. I think the second issue in terms of the past was the kind of long-term decline of relationship banking, which all the banks now acknowledge to have occurred. I mean, it would go back 10, 15 years, perhaps more, where local branch managers who used to be closely engaged with their local butchers and bakers and machine makers and the rest of it, increasingly became salesmen on commission, and all the mis-selling scandals came out of that. I think in many ways there's been an acknowledgement that that needs to be reversed. All the big banks have committed themselves to cultural change, and I like to think that's starting to happen. Unfortunately, as Andrew Tyree pointed out yesterday, the chairman of the Treasury Select Committee, we still get some of the problems arising. And I had a sort of public spat a little bit with the chief executive of Lloyds, who actually in many ways led the way here 3 years ago, but by withdrawing 500 relationship managers from the smaller end of the SME markets that seem to be going into reverse. So I think those are some of the kind of big legacy issues around banking competition. And of course, it's all been made much more difficult by the banking crisis. Banks, for perhaps understandable reasons, have now become much more risk averse. Not entirely their fault, whether they have much tougher capital requirements. And I think many of them, looking at their SME portfolio, see this as risky, relatively high cost in capital requirements and relatively high cost in servicing. And as a result, there has been a considerable contraction in SME net lending. Of course, there's also an issue about demand too. But the SME monitor that we track suggests that something of the order of 46% of applicants for SME lending don't get satisfaction. Of course, some of them just drop out and are discouraged. Some of them are eventually rejected. But there has been a fairly relentless contraction, which is, I think, only 3 months in the last 24 has there been any increase in net lending. So that's a sort of immediate problem that we're having to deal with. Now you could say, well, all this is history. We're now in a bright new future. But this is a critical issue because we're now getting into a recovery phase. It's got to be sustained. The recent survey suggests that 47–50% of all SMEs are now wanting to expand and take on staff, eventually investment in many cases. They're not going to be able to do it if they're constrained by a lack of finance. And of course, just another qualification, which is important, I think, at this stage. We always think of banks when we talk about finance. This is part of the oddity of the British system. In many other countries, notably the United States, equity, of course, has a much bigger role to play. We are trying to address it through tax reforms and other things, but certainly in the existing structure, when we talk about banks raising finance, we're primarily talking about the banking system or related systems like invoice discounting. Second point is, where are we? Where are we with competition? I mean, some very, very good things happening, and I think it is important to be positive. We are now getting substantial challenger banks, the two big carve-outs from Lloyds and RBS, TSB and Williams & Glyn's, very important development. I was surprised a couple of weeks ago when the leader of the opposition said what we need are two carve-outs from the semi-state-owned banks. I wasn't sure whether he hadn't realised it was already happening or whether he wanted two new ones. But anyway, it is happening, and that will be an important development. I think that, secondly, we are getting some new business models. I mean, Handelsbanken becoming increasingly important. Very, very solid local relationship base, no bonuses as I understand it. It's a different way of doing things. Good source of competition. We're getting the niche lenders coming in. Aldermore with Asset Finance and Shawbrook, Metro, I think, trying to get into SME lending. We're also getting some local banks, but this is very, very limited so far. I think the best example is Cambridge and Counties, which is operating in the Cambridge area in East Midlands. I think the only other one that we do have is Airdrie, and that goes back 150 years. In fact, one of the interesting and slightly depressing features about the UK banking scene is that unlike Germany and the United States, we just don't have these locally based institutions that, apart from building societies, which take deposits and support their local SME banks, but maybe that's coming. And more important than any of those things, this sort of really very, very rapid growth of peer-to-peer lending, crowdfunding. I think the latest figures I have is that there was a 90% growth last year. This year we're expecting to get to about 1.6 billion in this kind of new internet-based lending for SMEs. And that sounds great, but when you remember that gross lending altogether is 42 billion for the current year, we're talking 3 to 4% of the market. So it's very important in terms of driving down margins and increasing competition, but it is as yet quite a small segment. But nonetheless, a lot of positive things to report. Next point, what's the government doing? What are we doing through policy interventions to make banking more competitive and thereby improving access to finance? I think a whole series of things in train. One is the establishment of the business bank, which I've been trying to get going over the last year. And there are two elements to that. One is the business bank sort of grouped together a lot of the existing schemes, the guarantee scheme, the business finance partnership, that amongst other things has been co-financing peer-to-peer lenders like Zopa and the Funding Circle. It also runs the startup loan scheme. We've got 12,000 of those loans developed through the startup loan network. And I think something of the order of getting on for 3 billion of government-backed, government-supported SME finance is operating through those channels. In addition, and more interesting, we've got roughly 1 billion of capital from the Treasury for developing wholesale finance. We're currently in the market with 300 million at the moment, looking for partners. A couple of debt finance companies, Pricidian, and the other one is BMS, have already signed contracts, and others are out there. We're looking at partnering arrangements with invoice discounters and others, trying to diversify sources of funding, and particularly where you're getting serious financial innovation. So there's the business bank is one. I think secondly, the authorization process for challenger banks, which was very stodgy, very negative, very risk averse, that has been quite radically changed, I think, within the last 6 months to 12 months. There are now 20 banks under consideration. Now, of course, all those are niche banks. They're not potentially major, across-the-board banks, but nonetheless very welcome. And it's a combination of the regulatory procedures being made much simpler and less costly, and the capital requirements being made more proportionate. So I think you will find in a year or 2 years' time a lot more banks established and operating as a result of that. I think thirdly, the payments regulator has gone through Parliament, due to be operating in about 18 months, 2 years from now. This was what Cruikshank recommended 13, 14 years ago. The aim here is to stop the payment system being used in the same way that BT has prevented competitive access to the telecoms market. It's to stop a BT problem, and it will operate in a way that challenger banks have access to clearing without paying arbitrary penal costs and technical obstacles and things of this kind. Then access to credit information. We're currently consulting, which is government speak for we're about to introduce, subject to the feedback, a system of credit information sharing, trying to make sure that credit data goes to the credit reference agencies and that challenger banks have full and equal access to that. Again, there's a lot of mechanics involved, but the principle is established. And then finally, the whole issue, which was raised in the Vickers report a couple of years ago, of whether the whole banking industry should be subject to proper competition policy reference through what's now the CMA. The problem with the Vickers approach was because it takes 18 months, 2 years to have a proper competition policy review. It tends to blight the industry in the process. And we've taken the view that encouraging the existing carve-outs, the TSB, Williams and Linns, is probably a more practical way of doing it. But that does remain an option for us. And finally, just say a little bit about what I think are the two areas of emerging interest and controversy in terms of bank competition. One of them is the issue you've just talked about on the platform, which is technology. And I think there are two angles to this. I mean, one is the existing banks. There is a lot of, as has just been acknowledged, quite a lot of ancient technology. There was a survey recently by Tech UK that suggested that 80% of banks' IT goes simply on keeping the lights on, and only about 4% goes on to innovation. And this is a problem because when we do look at the issue about is it sensible to create more competition by, say, breaking up RBS, one of the controversies we've had. The argument always comes back, well, you know, the IT system, it's very complicated, very fragile, can't possibly do that, it will create a terrible mess and take far too long. Well, I don't know, but there are issues around the technology base of the existing banks which are actually making it quite difficult to pursue competition. In a way, a more promising line is making it easier for challenger banks to get access to technology platforms. At the moment, if you talk to some of the existing challengers, Metro, banks like that, they will explain that it's actually very, very difficult for a new institution with all the new risks involved in building up networks to be able to actually afford the big IT systems that they're required to get going. So one of the questions now being raised is there a shortcut into this? Can we adopt some of the American ideas? In the United States, there's what's called banking in a box. These are much simpler, cheaper IT systems. Companies like Fiserv, Temenos, I'm told, I'm not a technologist myself, so told that they can do this much more cheaply than has been traditionally the case in the UK. So far there hasn't been a demand for it. What we are now going to do is to try and make sure that the Office of Fair Trading, becoming the new Unified Competition Authority, is going to look at this technology question when it evaluates the competitiveness of the banking sector and see whether we can promote this technological breakthrough much more aggressively. And the final point, which I think is an area we should be beginning to explore, which is referrals. Now, the banks may have very good reasons why they turn down or discourage a lot of small businesses. I mean, they just not fit their model, high cost, and all these things, perfectly legitimate commercial concerns. But why don't they refer them to other people? Particularly when we have all the evidence that there's a lot of discouraged demand. Now, I think this is beginning to happen on a kind of ad hoc basis. Some of the banks refer the smaller companies that they don't want to do with themselves to the so-called CDFIs, the Community Development Finance Institutions. But why can't this be put on a more systematic basis? Why can't the challenger banks have access to these customers who the other banks want to walk away from? And I think one of the things we've got to look at, and we haven't come to any firm conclusion on this, is should we be setting up an exchange system so that referrals can be passed on in a systematic way? Would this be obligatory? And if so, obligatory in what sense? You know, do you require banks to pass on rejected cases to their competitors? I mean, there are tricky issues here, but I think it is something that we are starting to look at very seriously, and I think potentially a promising line of inquiry in relation to bank competition. But thank you.
Okay, so working. We're open for questions. Who'd like to be the first?
Well, it's a very interesting speech. Thank you very much. I'm Brian Catton from the Banker magazine. If the problem is really market failure, which is what you're saying, in the private sector, in other words, the private sector banks are not doing their job properly, clearly this leads to some of the measures you're talking about, in particular the business bank. The logic is that the public sector should therefore be investing much more in financing startups or directing investment the way the government would like it to go. So I'd sort of ask, I mean, how much more ought to be done, but without getting to the stage where we feel that funds, which has happened to some other countries, where funds are actually misallocated because there isn't a market determinant of them. How do you get that balance right?
Well, we're very clear that this is designed to supplement what the banks are doing. It's not to replace it. If it's replacing it, there's no point doing it, and it would be a misuse of public funds. You know, we are crowding in lending, not crowding it out. And but there clearly is a market failure in key respects, and we've certainly been able, in the interventions we've had so far, with things like Funding Circle or the new engagement with the debt finance institutions, to be leverage in very, very substantial amounts of private funding, which the promoters, we could reasonably, plausibly argue, wouldn't otherwise have happened. And it's partly establishing trust. I mean, in the case of, say, Funding Circle and Zopa, this is completely new. People are suspicious, lending money through the internet. The fact that the government has a small stake in it, I think arguably establishes something of trust. We don't guarantee it, of course, but I think it's helpful in activating a new market. We certainly don't want to get into the business of directly allocating government funding through the banking system. We don't want politicisation. This has all actually been done at one stage removed. The business bank is now operating under independent management. I would never be allowed anywhere near the lending decisions and wouldn't want to be. So I think that the fears that people might have of returning to some of the bad habits of the 60s and 70s, or that you see in a lot of emerging markets, and if there's any risk of that.
You mentioned earlier in your speech that there were some 20 banks that were awaiting approval with the government's new initiative. And I was curious, if these banks are trying new approaches or new technologies, we would expect a certain number of them to be possibly very successful and a certain number also to be unsuccessful. What sort of appetite is there to allow the new banks to fail if their ideas don't work? And are there mechanisms in place to allow them to do so? Or if the technology is very disruptive, they could potentially cause some of the legacy players to fail or to shrink and no longer be as successful as they were. I'm just wondering how that is anticipated to be managed.
Well, in terms of the mechanics of the new banks coming in and being licensed, I mean, the FCA and the PRA, I think people in the audience will be familiar with the alphabet soup of these new regulators. They're overseeing the process. Could they fail? Well, of course, yes. I mean, the whole purpose of the bank reform that we've undertaken, the big bank reform, the sort of Vickers reform, the separation of the so-called casinos from retail banking, is to enable bank failure to happen in an orderly way in future. And that relates to big banks, not small ones. So yes, of course, some banks will fail. The important lesson we've learned from the banking crisis is that you have to have proper depositor protection. We don't want Northern runs again ever happening in British history. So you've got to have a proper system of depositor protection. But that apart, there is no reason why institutions shouldn't fail, and indeed some of them will. And you're also quite right that if they are highly successful and disruptive, some of them will seriously cut into existing business. I'm less worried, I mean, I have no reason why I should be worried about that at all, but in many ways, the biases of some of our interventions so far have been in the opposite direction. A point that some of the challenger banks make to us is that some of the things we're doing, like the funding for lending scheme, which is now currently operating solely for SMEs, it's been withdrawn from the mortgage market, is that actually that helps the established players because they get access to cheaper funding. They can then undercut the challenger banks and offer customers more attractive deals without making more capital available. So if what you say is true and they are genuinely disruptive, that might be providing a helpful corrective.
So should the capital requirements against small business loans be reduced to ease the squeeze on small businesses?
Well, there have been already, as I understand it. I think the regulators were aware that the capital requirements on startup banks was pretty prohibitive at the outset, and they have made it more proportionate. Now, I'm not the best person to judge whether we got to a final point on that, or indeed whether the outcome is optimal, but there was a recognition that that was a problem, and it has, as far as I'm aware, been dealt with.
Funding for lending type theme, do you have any worry that Help to Buy is also diverting credit from SMEs?
Well, there are some arguments about the Help to Buy scheme Mark II, of which I've been quite made comments which have been controversial. Let's leave it that way. But I don't think it links to the SME issue. I mean, everything has an opportunity cost, of course, and the money that is going into the Help to Buy scheme could arguably be spent on other things, but it's not directly competitive with the SME market, as I understand it.
Okay, well, all it leaves me to do is to say thank you very much, and a fantastic, interesting insight into policy. Thank you very much.
Thank you.